Glencore's first quarter 2026 update, released Thursday, sent shares up 2% to 564 pence, a move that sits oddly against a one-year loss of 28%. The contradiction is not in the copper numbers, but in which part of the business is generating earnings. Copper output from the mining division rose 19% on year to 199,600 tons, and full-year guidance across copper, zinc, coal, and nickel was reaffirmed. Chief Executive Gary Nagle then added the headline the mining numbers do not capture. The marketing division, the commodity trading arm, sees full-year earnings before interest and tax comfortably exceeding the top of its annual guidance range, which runs from $2.3 billion to $3.5 billion. The bottleneck for the stock is not the mine count. It is whether the trading unit's outperformance is structural or a windfall that disappears when Middle East tensions ease. Nagle acknowledged on Thursday that the Iran conflict has pushed up costs in the industrial business. Diesel and acid consumption are running above plan, and the weaker US dollar adds headwinds. His claim was that these effects are being more than offset by wider commodity margins. That offset comes from the marketing unit's specific advantage. When supply chains are dislocated, routes disrupted, freight premiums elevated, regional price spreads widened, Glencore's traders earn on the gap between physical acquisition cost and delivery price. The Hormuz closure rerouted oil, coal, and gas flows across multiple markets simultaneously, exactly the environment that maximizes spread trading returns. That mechanism is distinct from copper mine operating leverage, and it is what the institutional holders, sitting on a combined $2.4 billion market cap loss in a single week in late June, appear not to have priced. The quantified disagreement is between RBC Capital Markets, which forecasts USD $2.4 billion in first-half marketing EBIT, and the consensus at USD $2.2 billion. RBC rates the stock outperform at 600 pence, 23% above Thursday's close. Citi separately argues coal could rerun its 2022 rally on lower Indonesian supply and falling Indian stockpiles, a different division as the next driver. Two houses, both positive, each pointing elsewhere. The market is pricing neither. The prevailing read prices Glencore as a diversified miner, with copper as the growth driver. Thursday's data exposes the buried assumption. Cobalt output fell 39% on year to 5,800 tons because the Democratic Republic of Congo imposed an export quota system in late 2025 that restricts all cobalt exports until at least end 2027. Cobalt sits on a structural demand curve, batteries for EVs and consumer electronics. Yet Glencore cannot freely ship the metal from its KCC and Mutanda assets, regardless of price or demand, for at least another 18 months. That is a regulatory constraint from a sovereign government, absent from the copper miner framing. Steelmaking coal fell 22% to 6.5 million tons, and energy coal 2% to 22.9 million tons. Deliberate curtailments, not operational failures. In this cycle, the earnings driver is price and spread, not volume, and the marketing unit is extracting that return while the industrial book absorbs cost inflation. A company exceeding the top of a USD $3.5 billion trading EBIT range is operating as a commodity bank, not a miner. The sharpest verification event is Glencore's first half 2026 results, which will disclose the marketing EBIT figure in full. RBC expects USD $2.4 billion for the half. Consensus sits at USD $2.2 billion. A print above USD $2.4 billion confirms the trading outperformance as structural. The 28% one-year drawdown becomes a mispricing. A print at or below USD $2.2 billion dissolves the Q1 signal into a volatility windfall that has already normalized, leaving the industrial cost headwinds as the dominant story. The counter case is in Glencore's own words. The offset depends on strong commodity prices it does not control, and a Hormuz reopening compresses the spreads sustaining the marketing margin. For a holder, Above USD 2.4 billion makes the 600 pence target achievable. Below USD 2.2 billion alongside a ceasefire signals the 28% decline is the direction, not a buying entry. For a watcher, the same number resolves the question. Opportunity if the marketing beat is structural. Trap if it was a one-quarter windfall borrowed from a war that ends. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.